Today we will be adjusting the accounts. Why do we adjust the books? First, we have some principles to cover. The first principle we'll cover is the revenue recognition principle, and it states that revenues are recognized when they are earned regardless of when the cash changes hands. So let's say, for example, I prepared a tax return for a client, and when I gave them the tax return, I also gave them a bill for $1,200. I have earned $1,200 because I have performed the service. Now we also have the matching principle. And the matching principle states that expenses are recognized when they are incurred and must be matched in the same accounting period against those revenues they help to generate. So we have to match our expenses with revenue. So let's say during the time in which I prepared the tax return for my client, I also had an employee that worked for me and earned $500 for which I paid them. I need to match that $500 of wages with the $1,200 worth of revenue that I have recognized. Okay, the next principle we need to understand is the time period assumption. This is also known as the periodicity assumption. Business activities are divided into periods of time, such as a year, quarter, month, or week. We also have a fiscal year, and a fiscal year is a continuous 12 months. Some businesses do not end their year at December 31st. Instead, it might be March 31st or June 30th, and that is called a fiscal year. And a calendar year is January 1st through December 31st. Okay, now let's compare cash basis accounting versus accrual basis accounting. So with cash basis of accounting, revenues and expenses are recognized when the cash is received or paid. And then accrual accounting utilizes the revenue recognition principle and the matching principle. So revenues and expenses are recognized when they are earned or incurred. So given the example I gave you where I prepared the tax return for $1,200 and I gave my client the bill, but they have not paid me yet, under cash basis accounting, I have revenue of zero because I haven't received that cash yet. However, I paid my employee $500 for that service. So now I have a net loss of $500. But that doesn't paint the real picture because I don't have a loss of $500. I have revenue of $1,200, but I haven't received it yet. And that's why we use accrual basis accounting, because now I can show my revenue of $1,200 that I have earned minus the expenses that I paid of $500. So I have net income of $700. This paints a better picture of what truly happened. And that's utilizing the revenue recognition and the matching principles. All right, so now with the three principles we discussed, we have to do adjusting entries at the end of each period. Okay. So now we have 4 different adjusting entries. 2 of them are deferrals or prepayments. So we'll have deferred revenue or deferred expenses. Accruals are paid in the future. And so we'll have accrued revenue and accrued expenses. So with deferrals, the dollars change hands first and the event happens second. So for example, let's say that a customer gave us a deposit, so they gave us the cash first, but we haven't performed the service, that would happen second. So that is considered a prepayment. Or if we paid our rent in advance, our dollars change hands first, we give our landlord the rent, and then we get to use the rent second. Now accruals means the event happens first and the dollars change hands second. So let's say, for example, we got the utility bill. We've already used the utility, we get our bill, but we're going to pay it later. And that is an example of an accrual. So let's go over each and every one of these. So first, let's start with adjusting entries for deferred expenses. And we have a transaction. ABC Company purchased office supplies on January 1st and recorded this transaction. So we had a debit of $1,000 to office supplies because it's an asset and we're increasing it, and we paid cash for those office supplies. So we're going to credit cash, which means we're decreasing our cash balance. So on January 31st, we counted the supplies we had left in our cabinet, and there was $400 worth of supplies. What is the adjusting entry that we need to do to record the use of supplies? Well, first we have to calculate how much supplies did we use. Okay, so if we started the month with $1,000 of supplies and now we have $400 left in our cabinet, how much did we use? We used $600, so we have to make an adjustment for $600. Okay, so what is our journal entry? We're going to debit supplies expense, office supplies expense, for $600, and we're going to credit our office supplies account for $600. This will reduce our asset account and bring it down to the true balance. So as you can see in the journal entry over here, we have $1,000 that we started with, we used $600, and now it properly reflects the $400 worth of supplies remaining. Okay, now on to our next entry, our adjusting entry for deferred expenses, and in this case, we purchased a 2-year insurance policy on January 1st. So sometimes you will pay for an insurance policy in advance, and it was for $3,600, and the company recorded the following transaction. It debited prepaid insurance for $3,600 and credited cash. Prepaid insurance is insurance we'll use in the future. It's an asset. And the reason we record it as an asset, if we cancel the policy, the insurance company will refund us that $3,600. We paid with cash, so we have to reduce our cash balance. So now, today is January 31st. We have to do an adjusting entry to record the expiration or using up of some of the insurance. Okay, so first we must calculate how much insurance is used. So our insurance policy cost us $3,600, and it is for a period of 24 months, right? 2 years, 24 months, same thing. So we take our $3,600 divided by 24, and we come up with $150 per month. So each month we must record expiring $150 worth of the insurance. So during January, 1 month was used, which is $150. So our journal entry is debit insurance expense for $150 and credit prepaid insurance for $150 to reduce that asset. So here we are, we credit the $150, which means we have $3,450 left in prepaid insurance. If we were to cancel this policy today, the insurance company would only refund us the $3,450 because we used 1 month's worth of the insurance. Okay, our next deferred expense would be a delivery truck. So often companies will buy an asset they intend to use for more than one period. And so we wouldn't want to record the $13,000 in expense all at once because that would not be a fair picture of the true expenses of the business. Instead, we'll purchase a truck and we'll use it for, maybe it's 5 years, 6 years, whatever it is, and we have to spread that cost over that time period. So here our journal entry is we're going to debit our delivery truck for $13,000. Delivery truck is an asset and we're increasing it, and we paid cash for this delivery truck. Cash is also an asset, so we credited that to reduce it. So today is December 31st, and we have used the delivery truck for 1 year. The company received a benefit from the use of the truck, and it helped them to produce revenue. ABC expects the truck to last a total of 6 years, and they believe they will be able to sell it for scrap at the end of the 6 years for $1,000. What is the journal entry needed for this truck? Okay. So the first thing we must do is depreciate the truck over its useful life. If you recall from the prior slide, that is 6 years. And when we say depreciate, that means we're spreading the cost of the truck over the time it is used in the business. Okay, so the cost of the truck was $13,000. When we sell the truck, we're going to get $1,000, so that is referred to as the salvage value. So the cost to depreciate is $12,000. So we're not going to depreciate the salvage value because that's what will be paid when we sell it. We're only going to depreciate the $12,000. The useful life is 6 years, so we have to divide by that, and we're going to depreciate the truck for $2,000 per year. And our journal entry is debit depreciation expense for $2,000 and credit accumulated depreciation for $2,000. Now you say, what is accumulated depreciation? Well, it's what's called a contra asset account. And what does that mean? A contra means opposite. So the accumulated depreciation has a credit balance. So if you recall, the delivery truck has a debit balance, and now the accumulated depreciation has a credit balance because it's a contra. And a contra account will always appear on the balance sheet next to the account for which it is a contra. So now let's show what it looks like on the balance sheet. So on the balance sheet, we'll have our truck for $13,000. We currently have accumulated depreciation of $2,000. So on the balance sheet, we'll have a book value of $11,000. Each year when we depreciate that truck, we add it to the accumulated depreciation. So at the end of year 2, we will have $4,000 in depreciation and then a book value of 9. Okay, so that is it for the truck. Now let's move on to deferred revenue. So deferred revenue is when a customer pays us in advance. So this customer made a deposit of $600 for work to be performed in February on January 1st. And the following entry was made when the deposit was received. We debited cash for $600 because we received cash, so that means we increased our cash balance, and we credited unearned revenue for $600. Unearned revenue is a liability account. So if we don't perform the service for the customer, we have to then refund them that $600. So we cannot record it as revenue, so we record it as a liability because we owe that money to the customer. So today is February 28th, and it's been determined during the month that the above job was completed. So we performed the service for the client, and now what would be the adjusting entry? Okay, so the job was complete. So first we have to calculate out how much revenue we have earned. So since the job is 100% complete, we have earned 100% of the revenue, which is $600. So now we're going to debit unearned revenue for $600 and we'll credit service revenue for $600. So that reflects our earning the income, and we will zero out the unearned revenue account and it will be 0. Okay. Next, we have an adjusting entry for accrued expenses. So if you recall, the event happens first and then we pay it later with accrued expenses. So ABC Company has one employee who works a 5-day work week and is paid $200 a day. They are paid every Friday for the work performed that week. However, this year December 31st falls on a Wednesday. So Monday, Tuesday, Wednesday's wages are all earned in the prior fiscal year, and then January and 1st and 2nd are for the next fiscal year, but the employee will be paid $1,000 on payday. So at December 31st, we do adjusting entries, we do closing entries, and we do financial statements. So we have to make sure that our expenses are properly accrued so that it's complete and we match all of our expenses with our revenue. Okay, so what entry is needed on December 31st to record the wage expense in the current year? First, we have to calculate how much is owed in wages. On payday, the employee will be paid $1,000 for 5 days worth of work. However, 3 of those days were worked in the prior fiscal year. So we must accrue $600, which is $200 times the 3 days worked in the prior fiscal year for the wages that were earned in the prior fiscal year. Okay, so our journal entry is to debit wages expense for $600 and to credit wages payable for $600. All right, now we'll do an adjusting entry for accrued revenue. On November 1st, ABC Company sold merchandise to a company who signed a 6-month note. They agreed to pay 12% in interest for being loaned $10,000. The following transaction was recorded by ABC. Debited notes receivable for $10,000 because that customer owes us $10,000, and sales revenue of $10,000 because we earned the revenue. What adjusting entry is needed on December 31st in relation to this note? Well, the customer hasn't paid us, so we don't have to record that. However, since the customer is going to wait 6 months to pay us, and we signed a note receivable, we have to accrue interest earned on that note. Okay, so the customer owes us the $10,000 and the interest rate is 12%. That is an annual interest rate. So when we multiply that, we get $1,200, but that represents 1 year's worth of interest. If we look up above, the note was signed on November 1st, and so we have to record 2 months worth of interest, so at December 31st, how much interest have we earned? So the time period is 2/12 or 2 months out of the fiscal year. And when we multiply $1,200 times 2/12, we can calculate out that $200 worth of interest has been earned. So now let's do our journal entry. We will debit interest receivable for $200 and credit interest revenue also for $200. And that is an example of accruing our revenue and making sure that our books are complete. And that is the end of our adjusting the accounts.